In the early 1970s, mortgage interest rates in the UK soared to 17% and the inflation rate was 25%, a difference rate of 8%. This was mostly due to rising oil, energy prices and wage increases. If all prices, wages and interest rates had adjusted with inflation, then no one's purchasing power, profits or real loan repayments would have changed. If the economic variables do not move exactly in sync with inflation, or if they adjust for inflation after a time lag, then inflation can cause problems like unintended redistributions of purchasing power, blurred price signals, and difficulties in long-term planning. People can sometimes benefit from the unintended redistributions due to inflation. If you buy a car at a fixed interest rate of 9% and the inflation rate is 3%, then you must repay the loan at a real interest rate of 6%. If inflation rises to 9%, then your real interest rate on the loan is zero. Borrowers paying a fixed interest rate may benefit from a higher inflation rate. Borrowers may repay their loans in dollars that are worth less than their original value. Investors, including retirees receiving payments at a fixed interest rate, will suffer from a higher inflation rate. Lenders may receive repayments in dollars that are worth less because of inflation. Homeowners may benefit from higher inflation because the price of their homes rise. Renters may suffer if they are paying higher rent due to rising landlord costs. When the difference rate between inflation and interest rate changes, it will penalize someone. The unintended redistributions of buying power when the difference rate changes may have a broader effect on society. America's acceptance of market forces rests on a perception that people's actions have a reasonable connection to market forces. One of the reasons that the public dislikes inflation is a sense that it makes economic rewards and penalties more arbitrary and is perceived as unfair. Outcomes are not always deserved in any way.